Hello and good evening to all of you. I hope you can all hear me. My name is Patrick Prunty. Welcome to How to Keep Up with Inflation, our webinar tonight conducted by Daniel Amaduri, who is an inflation expert, and he's also the chief strategist at Future Money Trends, which is a research company he founded, and they focus on macroeconomic trends in the U.S. economy. As I said, my name is Patrick Prunty. I'm part of the Marshall Reddick Real Estate Network, and I'll be the organizer for this webinar. Before we go any further, I just want to tell you a little bit about myself. I've worked here for Marshall for a number of years. I started back in 2003, and I was attending Cal State Long Beach at the time, and I started kind of as a student intern with him. Like many of you, I've had the opportunity to invest in the network, and I'm currently in process of purchasing my 5th investment property, and I'm doing so through my Roth IRA, which kind of transitions right into what we're going to learn about tonight, ultimately. And, with that, I want to take some time here and introduce Daniel, who I had the pleasure of meeting for the first time a few months back at one of our Marshall Reddick events in Pasadena. And he wasn't a guest speaker that night. He was there just like I was as an investor. Unfortunately, I missed his presentation on inflation held at our Millionaire Club last month. So I'm excited, just like the rest of you, to hear what he has to say, and so we can get some more information on how we can keep up with inflation. So, Daniel, with that, you ready to get started, bud?
I am. Thanks for joining me, everybody. I think you guys are really going to enjoy this presentation. It's a presentation that I've actually been giving for a few years, but I've altered it in the last year to focus more on real estate. Starting about 2007, 2008, I started putting out a warning for everybody to actually sell real estate that was looking for capital appreciation and short mortgage companies. Obviously, that turned out really well for our investors, and it's really kind of what launched my website, futuremoneytrends.com, and launched me in the inflation world as far as being able to go and present my ideas on different radio shows and TV networks. So I'm very grateful, to everybody who takes the time to see the things that I'm very concerned about. I originally was just a business person who happened to be buying a lot of real estate at the time as well, but I've also traded stocks. I've been buying real estate since I was 18, and I was really just concerned about the economy because it was a personal hobby of mine to focus on macroeconomics. And so I started warning my family and friends in about late 06 and especially 07, and no one would listen, and that's really when I started to build a new business that researched and gave information to people that focused on macroeconomic data that is inevitable. So what I'm going to show you tonight, and if everybody's paying attention and really focused on this, it'll really be jaw-dropping for some of you, because I'm going to show you some things that just cannot be changed. We are going to have a significant amount of inflation. And because of our demographics, that's the individuals, the people who have already been born, and our spending habits, there are some forces at play here that we cannot stop. I first want to define inflation. A lot of people on the news will talk about gas prices being up or food being up, and they'll call that inflation. They'll say inflation's up because food is up or because gas is up. But the purest form of inflation and the definition of inflation is an increase in the quantity of money and banknotes in circulation. So basically, when the Federal Reserve prints money, that is creating inflation. Inflation is not rising prices. So you can actually have inflation printing money and not see rising prices right away. Rising prices is a result of inflation, but it is not the source of inflation. Inflation is caused by the Federal Reserve, private banks, and the U.S. government. Just to give you an idea on how our money expands, obviously you have the U.S. government that spends money, and if they focus on one thing, let's say solar panels, and start doing subsidies, you're going to have inflation in that sector because the government is spending money. They're increasing the quantity of money for that area of the economy. You have private banks. When people make deposits, the banks can loan a lot more money than they actually take in on deposit through fractional reserve lending, as well as when people apply for credit cards. Most people don't know this, but when a bank takes a credit card application, let's say you're approved for $10,000, they actually enter it in the end, as far as digitally, they enter that $10,000 credit approval as a deposit, and then they loan it back to you. Of course, when you spend that money, somebody will inevitably deposit it in some other private bank, and because of fractional reserve lending, even more money can be created. And of course, the Federal Reserve is the big one. The Federal Reserve loans money into existence. And that's an important thing to understand, because a lot of people like to just say, oh, here they're printing more money. They're creating more money out of thin air. And that is true. But it is important to note that the Federal Reserve loans money into existence. So every dollar that is loaned out that the Fed prints has an interest rate tied to it. Therefore, because we are under a Federal Reserve system, we will always have inflation, because as the Fed creates money, the borrower, typically the U.S. government or the private banks, will have to pay the Federal Reserve back with interest. Inevitably, there is simply not enough money out there to pay back the new money that's created, so you'll always have to increase the money supply. Now, there is a recovery that the media likes to talk about, and a lot of people have said, you know what, it doesn't feel like a recovery, but the stock market keeps going up. Well, the stock market's going up because there's a lot of new money entering the system, and it typically focuses on more speculative investments. Now, this is the actual monetary base of the United States. If you guys can see that, you can see that just after 2000, you can see that little tiny blimp up. And that was 9/11. And of course, you can see it completely goes parabolic starting in late 2008 and early 2009. When you see it go parabolic and has a short correction, that was the first thing called quantitative easing, which has been in the news a lot, also known as QE1. And the second one has been quantitative easing 2. Now, this money is sitting mostly in banks, bank reserves, so this has actually not entered the system. So it's important to note that this is pure inflation, but we are not seeing the prices rise yet because the money has not entered the system yet. When it comes to our federal government, this is our national debt. It took roughly 40 presidents and 204 years to reach our first $1 trillion back in 1982. And our last $1 trillion that was added to the national debt took roughly 7 months. So you can see that we have now reached really a parabolic stage of where we're borrowing so much money, not only to pay back the interest on the previous money borrowed, but there are so many promises and mandatory guarantees out there. Of course, this money is causing inflation. Now, it's important to note that the government has changed the way they calculate price inflation over the decades. The blue line is actually the way the government calculated inflation in 1980, and the red one is the way they calculate it now. Now, you can see, you know, if you watch the news, they'll tell you that inflation, price inflation, is 2%. But if you look at the way they used to calculate it, 1980 base, it's actually around 10%. And the biggest change they made was they stopped including food and energy. And of course, food and energy are the things that we need. And when those prices are going up, the government has taken it out of the price inflation. So it's important to note, because this number that the government uses is used for Social Security checks and a lot of people's raises. So senior citizens, if they were to be given checks with an application of the 1980s CPI, their checks would be 44% higher than they are today. So the government's able to save money. We're able to go into less debt, but the calculation of inflation from the government is no longer a cost of living increase. It's turned into the cost of survival, because it is not giving us the true inflation, and it is not changing people's pay and fixed income according to true price inflation. Inflation destroys currencies. Now, we have had over 3,000 fiat currencies in human history. Every single one has eventually ended up at zero, with the exceptions of the ones that are around today. Now, if you look at our fiat currency, the US dollar, which is a Federal Reserve note, we have had 4 currencies in the United States since our beginning. We have had the US Continental, which died of hyperinflation. We have had the greenback, and we have had the gold-backed dollar, and then we have had the current one that we've had is the Federal Reserve note. To give you an example of what has happened to the value of money, when people think that they're saving their wealth, I always say, you don't save wealth in fiat money. That's paper money that's created by people and is fundamentally flawed. But here's the raw stats, and this is actually using the government CPI. So this isn't even using the one they used in the 1980s. This is using the current model. If you look at the top, $100 in 1982, so if you took $100 and put it under your mattress thinking it was safe, and then you wanted to spend it today, it would only have about $41 in purchasing power. $100 in 1992 under your bed and spent today only has about $60 in purchasing power. And 10 years ago in 2002, right after 9/11, if you would have taken $100 and saved it for somebody, you would have about $78 of purchasing power. And then, of course, the big one is $100 in 1913. The reason I use 1913 is because this is when the Federal Reserve took over our currency. They started to manage the currency of the United States. That $100 saved in 1913 only has about a $4.25 purchasing power in today's value. So inflation destroys the wealth of those who keep their savings in fiat currency.
Daniel.
Yes.
I apologize to interrupt. We're getting some questions and some response from the people listening, and I as well do not see your screen changing, and I believe we're supposed to be seeing some of the graphs and things that you're talking about.
Oh yeah, you guys should be seeing all my charts and stuff. Do you see my screen at all?
There you go.
Okay, so you guys can see this screen?
I can see it now. I'm assuming that everybody else would be. If they could please, type in there and let us know, we'd really appreciate that.
Let me go to the full screen. Because I'm watching blind. Can you see the full screen now?
It's all black for me now.
Okay, I'm going to go back to.
There, I can see now.
Okay, then we'll just do it from this. If everybody can see this, I will just briefly go to the charts that I wanted to show real quick then.
Thanks so much, Jen. Appreciate it. And thank you to all you guys listening. Appreciate the feedback.
Real quickly, going back earlier, I was talking about the increase that the Federal Reserve has, how much money they printed. If you guys can you see my mouse, Patrick?
Yes, absolutely.
Okay. Okay, so this right here is basically right after 9/11. You can see that they started to print some money. They were worried about the banking system. And, of course, right here is 2008. This is quantitative easing 1. This is quantitative easing 2. So you can see that throughout all of history, the monetary supply has increased since the Federal Reserve was created, but we've had a significant increase since the 2008 banking crisis. This was my chart of the national debt, and this is a chart of the annual CPI. So you can see that this is the government's own inflation data. This is when we had those really high interest rates in the early 80s. And they did some changes in 1982 to the model, but the big changes really happened in the 1990s. And you can see that the inflation from the government, the price inflation number that they keep track of, has remained relatively stable in that 2% range. But if you actually look at just using their own model from the 1980s, we've been dealing with significant inflation for the last decade. Let me go back to where I was. So here's where I was talking about the currency, and here's our next slide. So Patrick, are you guys with me?
Absolutely. Everything
okay,
looks
so
good.
the last 20 years, versus the next 20 years? This is an important question because so many people and so many pundits will talk about how there's historical precedents for like stocks that things will just continue doing or they move in cycles, and that is true for some things, but it is important to understand what will drive our economy for the next 20 years as compared to the last 20 years. Can we use history as a guide? Will we have inflation? Will we have deflation? Education and information, without a doubt, is the most important thing, and I believe that it will dramatically change everything when what people are thinking when they look at the raw data of the things that they cannot change, even the government can't. And the big one is demographics. Knowing the spending cycle of a human being, understanding the impact of having a baby boomer generation, and realizing that the next 20 years will be dramatically different from the last 20 years. Everybody listen to this. It's important to know the next 20 years is going to be radically different. You saw the debt chart. You saw the monetary base. It took 204 years to get the first trillion, 7 months to get the last trillion. We're in a much different situation than we were in the last century and certainly the last 20 years. Now, here's something important to see, and I've got a visual shot of it. This is from Harry Dent. He's a great macroeconomic person for research. The spending cycles of a human being. And this is important because of the baby boomer generation. But let's go over this. Roughly, your spending peaks at about 46 to 50 years old. And the reason that happens is this information, by the way, is from the Census Bureau. That's where he got it, and the Commerce Department. So if you look at somebody who's 18 to 22 years old, they're not spending that much. They don't have a good job. Their spending increases as they get older. They may have graduated from college. They've got a decent job. They're starting to climb up the corporate ladder. They've started their business, is making money. They get married. So now they have more expenses. They're buying furniture. They might be buying a house. Once you turn 31 to 42, those are pretty much the ages people have children. And when you look at that, why would we peak at 46 to 50? Well, because if you're having a child at 30 years old, your child turns 16 at 46. So anybody who has teenagers knows that teenagers consume more calories than they ever will in their entire life. And they want more gadgets. A child's toys and a child's clothes are very cheap relative to a teenager's. When I have a 2-year-old son, and if I want to buy him a T-shirt, it could be anywhere from $5 to $15, $20. But if I wanted to go buy a T-shirt, let's say Pacific Sunwear, all of a sudden you're looking at $35 to $50. So your teenagers, everything increases in spending, and of course as they go into college, your expenses and spending increases even more. For those that are younger that are listening to this, just, if you have a young child, or you can take my own life for an example, 5 years ago I had no children. So my wife and I were spending money, but we were saving a lot of money. But now we have kids, so we're spending more. We're buying diapers. We're buying baby food. We're buying things we would have never purchased. So that's why you increase in spending as you age. However, once your kids leave, your spending does collapse. That part of your life is called the empty nesters, and you can actually see once you get into those retirement years, 60 years plus, you actually will spend less than an 18 to 22-year-old. It's important to know that because from 1946 to 1964, according to the U.S. Census Bureau, we have a generation called the baby boomers, and I'll show you a chart in a second. This is the largest generation in U.S. history. It dwarfs the generation before it and after it. Now, it's important to realize that it dwarfs the generation after it because that means the spending that's been going on in the United States for the last 20 years can't possibly be the same because the people are less than the baby boomers. There are just simply less people, less of a population in that age group. Just to give you an example of how powerful this baby boomer generation is. In 1957, we had a record year for births in the United States, and that held the record for 5 decades. The baby boomers peaked in their spending habits in 2010. And what that means is the first baby boomer turned 46 years old in 1992. And you can imagine a wave of baby boomers hitting peak spending all throughout the 90s. And everybody remembers the 90s. It was great. Huge, huge boom in the U.S. economy. 24 million jobs created. You had a combination of the baby boomers hitting peak spending, so they're spending more than they ever have. And you also had the internet boom, of course. So here's a great chart. 1/3 of our population is the baby boomers. So you can see the generation before the baby boomers, and you can see the huge dip in the baby boomers after the baby boomers. Now, the baby boomers' children, you can actually see right here, starting to happen in the 1980s and 1990s. That is called the echo boom generation. Now, the first baby boomer turned 46 in 1992. The last baby boomer will turn 46 in 2012. From 1992 to 2010, the U.S. economy experienced a flood of new spending from 1/3 of its population. It's important to note because the U.S. economy is a 72% consumer-driven economy. How will this affect California's economy? Well, we have it even worse. 81% of our economy is the consumer-driven economy. So it's important to note that we have, because of the baby boomers, structurally changed our economy to a consumer-driven economy. However, there are going to be a lot less consumers, and those that are consuming won't be consuming as much over the next 20 years. The inflation is coming because the baby boomers will collapse in spending. This will force the Federal Reserve to keep rates artificially low and provide more quantitative easing. It's important to note that the baby boomers will move into their retirement years, which some already have, and they will apply for Social Security, they will apply for Medicare. Social Security applications in the 1990s was about 500,000 per year. From 2012 to 2025, it will average 1.5 million per year. So Social Security equals mandatory spending. Now, when you look at this, you're seeing a collapse in spending, which means a collapse in tax revenues, and also those baby boomers who quit their jobs will not be replaced by somebody who makes just as much as them. The person will make less. They will have to work up the corporate ladder just like they did, or even if they replace the same position, they may not be in the same bracket as far as how much money they're going to make, and they may not be in the baby boomer situation where they would have had more kids. So you're looking at a collapse in tax revenues and a massive increase in mandatory spending. So that's going to create a huge gap in our national deficit. Just to give you an idea of what that looked like for 2011, the United States in total revenues, this includes all taxes, 1/3 of this is about income taxes, but all taxes, if you look at the top there in revenues was $2.3 trillion. However, the U.S. government spent $3.6 trillion. So we had a $1.3 trillion deficit last year. But here's the scary part. Total revenues was $2.3 trillion. The mandatory spending, that's Social Security and other entitlements, mandatory spending was $2 trillion. So we barely covered our mandatory spending with all the current tax revenues. Now, what do you think is going to happen when this mandatory spending dramatically increases because more people are going to be on Medicare and Social Security, and as they quit their jobs and spend less at Target and Walmart and on family vacations, on gas, as this tax revenue collapses, you're going to see this go up dramatically at the same point in time. So what will happen is, as bad as this chart looks right now, it will be significantly worse. The next president will absolutely see $20 trillion in national debt. It will exceed $20 trillion. In fact, as you can see it increases as the years go by because of the mandatory situation in spending. Now, I've showed you that there's going to be a significant amount of inflation. I don't think we can do anything to stop it because it's about demographics. Now, most people might say, hey, that means we might have a deflationary force, and that's true. However, we have a Federal Reserve that is going to do everything they can to keep the system going with inflation. You have to remember, price inflation is obviously tied to how much government revenues are going to be. And any Federal Reserve chairman or any member in Congress or the president is going to want to keep prices elevated through inflation. Now, how to profit and protect from inflation? There are several things you can do. You can own hard assets, real things. I consider housing in that category. You can diversify your wealth out of the U.S. dollar, out of the current fiat currency that is the world reserve currency, and of course the currency of, it is the medium of exchange for all Americans. There's gold, silver, there's resource companies. Real estate, in my opinion, is the best way and the safest way to profit from inflation, though. And I want to compare single-family homes to gold. Now, I want to disclose that just as I was very bearish on housing in 2006 and 2007, I'm very bullish on housing now, but I'm also very cautious, and I also buy gold. Now, gold I consider money, and there are some huge advantages to buying single-family homes versus gold, but I'm certainly not saying that gold is a bad investment. I'm just saying single families are a much better investment in the bigger picture. So if you look at a single-family residence, it's a package of commodities. Your house has silver in it, has copper in it, lumber, concrete, a lot of natural resources. It takes energy to build a home. This doesn't include the other costs like people pulling permits, manpower. So your house, if you take a look at your house, you have a package of commodities. Gold is one commodity. And again, I use gold because many people who acknowledge that there's going to be a significant amount of inflation immediately jumped and buy gold. Gold has been money for over 6,000 years. It has not been an investment. And if you talk to any of the big gold bugs, they'll tell you that. I mean, gold, yes, it is going up in dollars, but really it's kind of a brain teaser, but you have to look at it as the dollar is going down. And so gold is a very stable investment. It is money, but it is not typically treated as an investment. Now, the single-family home, single-family residence, it pays a dividend through rents, through rental income. Gold does not. Single-family residence can be leveraged. Gold cannot. And I have a physical example in the seminar that I do in person. And it's amazing. If you have a 100-ounce bar of gold, it actually fits in a VHS cassette tape sleeve. So just try to put that in your head, and actually there's a lot of room to spare. So 100 ounces of gold right now is $150,000. So you can have this piece of metal, this commodity, that's worth $150,000, and it's not even as large as a VHS tape. Or you could have a home, which obviously you possibly could have acreage for $150,000 in some of the states that Marshall Reddick focuses on. So it's important to note that when you step back and say, hey, wait a minute, single family or gold, when you're looking at charts and numbers, you can make these comparisons, but when you're actually looking at what you're getting, you're far better off buying a structure, something that can be rented out, something that, where you own a piece of the earth. Now, are the demographics good for real estate? I like to be brutally honest. Yes and no. Let me go with the bad part first. The baby boomers peaked in home buying in 2005. You typically buy your first home. The average American, according to the Commerce Department, buys their first home between 28 to 32, and they buy an upgrade house around 35 to 42 years old. Roughly, the baby boomers peaked in 2005. These same buyers of the 1990s, that were buying the bigger, more expensive, more roomier houses that helped the boom in the early 2000s, they will now be sellers looking to downsize. So we may have a huge situation where there's a lot of sellers selling good quality homes as they will be looking to downsize and they become empty nesters. The echo boomers, which is the baby boomers' children, they don't really come into play in our economy until 2023. They are in the economy. They're in their 20s and they're even in their young 30s. So they are starting to spend some money. However, the first echo boomer does not turn 46 years old until 2023. And again, it's important. There's a huge difference between the spending you have when you have a toddler and the spending you have when you have a teenager. Go to Target and price out the bikes for a 2-year-old and for a 16-year-old or for a 12-year-old. There's a big difference. They also, like I said before, consume a lot more food. So that is the negative part of real estate, but there may be some headwinds. And of course, with the economy and the lack of driver for jobs, you're going to have sustained high unemployment, a new normal. Now, the baby boomers will be looking for rentals, though, as they graduate college and enter the workforce. So I do believe because it is hard to qualify for a mortgage and because they may not have as good as jobs as their parents did, there will be an increase in rentals. So what I always tell people is if you're buying a home looking for appreciation, I don't know if that's a great bet. If you're buying a home looking for cash flow, Marshall Reddick has a great network to do that. I don't think you can lose when you get cash flow. In fact, I'll show you later towards the end of the seminar that you cannot lose if you go for cash flow. Now, the catalyst for people to rent, it kind of looks like bad news, but it's actually good news if you're a landlord. And real quick, back to price appreciation real quickly. One thing I want to say is if you're buying a house and you're worried about it collapsing in price, you're buying in the wrong area. If you look at some of these properties, and I bought a few from in the Marshall Reddick Network this year in the Memphis area. These houses, amazing. They're selling for $40,000 to $60,000, and when you call up your insurance company to insure it, they end up insuring this house for double than what you paid. So you buy it for $60,000, and they're insuring it for $120,000 because that's what it would take to build the house. And of course, it's going to cost even more to build homes as price inflation hits commodities. So the catalyst for people to rent, foreclosures. Foreclosures are projected to reach 1 million in 2012. 1 in 4 homeowners are upside down right now, and we have roughly 9.6 million in shadow inventory. That's a significant amount. This is basically inventory that's out there that the banks are holding on to because they don't want, in certain areas, like let's say certain parts of California. Stockton's a good example. They don't want foreclosure signs on every single house. Long-term unemployment, there is no driver for jobs. My advice to people who are unemployed or looking for a job or who have a job, if you have a job, keep your job and bring your A game every day because there is no internet boom and there is going to be no spending boom. So there is no driver for jobs. If you look at the underemployment in the United States, we have roughly 25 people underemployed. This means you're either fully unemployed or you have a degree in science and you're working at Jamba Juice. So there are 25 million people out there, and of course this doesn't include the new people that are going to come in as they graduate. But it's important to note that during the 90s, during that amazing boom we had with the internet and the baby boomers, we created 24 million jobs. So in order to get back to like the early 2000s, we would have to have something of that scale just to absorb what's currently, the people that are currently looking for work. So I don't see that happening. If you look at Gallup, who takes polls of presidential races and is paid for their accuracy, they have polled underemployment. They have it actually at about 17%. Right now. So I tend to believe Gallup over the Bureau of Labor Statistics. There's a lack of qualified buyers. Just as standards were too loose in 2008, they've gone the other way. Now they're way too ridiculously tight. So this can also cause a lot of people to rent. And that also plays into the perception because a lot of people can qualify, but that they just don't even want to try, so they're renting. And overcorrections are normal and should be treated as opportunities, especially for people who want to be landlords. If you look at the evidence, we are absolutely seeing a rental boom. In 2000, we had 33 million renter households. If you skip to 2010, it was 37.7 million renter households. So you can see from 2000 to 2005, we had, basically, a million people added to that list. We had a jump here from 2010, and you can see it continues. In 2011, we had 40.1 million renter households. So again, we are absolutely seeing this play out. So the analysis is that more people will need to rent and want to rent, and that's exactly what's happening. Profiting from inflation, I think the best thing about real estate is the leverage. And right now you can lock in a low rate for 3 decades. Owning a hard asset that appreciates from both population and inflation, the loss of the value of the actual currency itself. So you can control this massive asset, and you don't have to come up with $150,000 if you want to own a $150,000 house. You do have to come up with $150,000 if you want $150,000 worth of gold and silver. You get residual income, and is a tax-friendly asset, real estate. I have some examples. I'm going to go over them briefly. I don't want to tie anybody up in numbers because I want us to have time for questions and answers. But if you took an example of a $120,000 single-family house, and I just use round numbers, and purchased it today, and you had a 30-year loan and $100,000 with a loan at 4.5%, you have a payment of $506. Now I put in some rental income and some expenses, insurance, property management, vacancy and repairs, property taxes, and basically your income is about $2,500 per year, and you have about $213 you're making per month, which equals about a 12.8% return on the $20,000 you put down. And remember, I did include some budgeting for vacancy and repairs. So that's a way to get about a 12.8% return on just the cash flow aspect. But that's not the best part about using real estate as inflation, as a hedge against inflation. Now, going back to the big picture, that same example of the $120,000 single-family home, a total paid over 3 decades will be $182,000. Now remember, the tenant pays this. They're the ones paying the mortgage off for you. Now that $120,000 house, if you just saw a 3% annual return on that house for 30 years every year, on average, even though it's a little higher for real estate, that house would be $291,000 or $271,271. So a 5% return brings that house to $518,000. A 7% return would be $913,000. And most people on Wall Street would say, hey, that's not bad, a 3%, a 5%, or a 7% return. But what's so crucial and so important to understand is if you put $20,000 down on a home, you are not putting out $120,000. So your return is going to be dramatically higher. A $20,000 investment used to control a $120,000 asset that can benefit from price inflation. Your real return in 3 decades is really 9.3% to 13.5%. Now, I did not include the cash flow in this projection here, and the reason I didn't is because I like to always be extra conservative. So let's say you've got to do a new roof and you've got some major repairs, and let's say that 12% you were earning, and by the way, you'd probably raise the rents over 30 years. Well, let's say that 12% you were earning on the original $20,000 you put in. Let's just not even think about that. Let's just focus on if the tenant paid off the house that was worth $120,000. Now, if the house was rising 3% or 5% or 7%, you can see your $20,000 return, because that house is worth $291,000 in 3 decades. Your actual return is 9.3%, or on 5%, it's 11.6%, or on $20,000 down on a $120,000 asset that actually the asset's going up 7%, your real rate of return is 13.5%. But remember, it's important to note that we are seeing already right now 10% inflation, so you have to see these higher returns. If you aren't seeing at least a 7% return, you are losing money right now. Your real wealth is shrinking. So if you're buying CDs or buying bonds, you are actually losing purchasing power. Now, just to show you how conservative you can be with this, if you had a $120,000 house with a $20,000 down payment, financed over 3 decades at 4.5% interest, the tenant pays it off in 2042. Let's say the house in 2042, a house you bought for 120 grand today, in 30 years is worth 120 grand. Now, I don't believe that for a second, but just to show you that it still could work out for you, because you only put $20,000 down and because your tenant paid off the house, that $20,000 investment that you made is now worth 120 grand in 2042. That's a 6.5% annual return. And here's where it kind of gets crazy. A $120,000 house, and we're still talking about the same house, same down payment. Just focus on this third one right here. If everybody's worried about real estate going down more, in 2042, talking 30 years from now, the house has collapsed in value and is now only worth half. It's only worth $60,000 in 2042. Because it is leveraged, your $20,000 still sees a return of 3.7%. Now, that return to me sucks, but I'm just showing you an extreme example. And it is this would be known as a healthy return on Wall Street now for bonds and for safer investments. But that's why I can advocate easily that real estate is without a doubt the safest way to get a safe return. And remember, this whole entire time, I have not been counting cash flow. I'm just simply talking about somebody paying off a $120,000 asset for you. The opportunity is massive inflation is coming. And right now you can lock in a loan made in the U.S. dollar at historically low interest rates. You can control package of commodities. Remember, houses, all your electronics have silver in them, your pipes have copper, your lumber. You can provide housing to others and exchange a weakening currency for a real asset. Financed in a currency that has lost 58% in the last 30 years, according to government statistics. That is not a bad deal, because if you think about what's going on in the last 30 years, the currency has lost 58% of its value. What do you think is going to happen over the next 20 to 30 years as we have to print and create even more money because of the structural imbalances that are demographically in our economy? So that is the opportunity in real estate. Own an asset, control an asset that is real. You're storing your wealth in something that is real, not fiat currency, and you're receiving a healthy rate of return that will beat price inflation. This concludes my seminar on what you can do and how you can profit from inflation. If you'd like to check out my website, you can become a free member. We simply focus on educational articles and investments and videos and things that the macroeconomic economy is kind of laying out for us, where we can make wise decisions on how we live our lives and what we spend money on, how we make our investments, that you really don't see covered in the mainstream media. They tend to just kind of focus on the daily hype. So if anybody has any questions, I'd love to answer them. Patrick, I'll hand it over to you now.
Well, Daniel, thank you so much. That was really enlightening. I must say a little bit scary as well. But I'm glad I'm in the process of buying my 5th property, let's just say that, because I'd much rather have it there than under my mattress, or you know, at least getting a little bit of diversification out of the stocks and the mutual funds and the bonds and the CDs and the other things that I purchased. You know, it's been just a wild ride for me, seeing the market over the last couple of years, and it's really made me extra conservative, and listening to my folks and my relatives and everything, and and they're even more conservative than I. And when I say that, I mean they're holding on to cash, which you convinced me I definitely do not want to do at this point. But yes, absolutely very informative. And if there's anybody out there listening that has questions, I'd be glad to field those and pass them along to Daniel. So just give me 1 second here. Okay, Daniel, I got a question for you. It is it better to invest 401k money in real estate with leverage or just outright cash?
You know, I don't think it, you know, it depends how old you are, but I mean, in the end, I don't think it matters because you're either way you're getting the real estate investment. So I think it's better to use the 401k only because I don't think you're going to do very well in U.S. mutual funds for the next decade. I think the economy, or at least the stock market, is going to continue very volatile. I wouldn't be surprised if we actually saw a crash in the next 4 to 6 weeks here. So I don't think you should be putting your money, significant amount of money, in stocks blindly. So I think your 401k is far better off in real estate.
Daniel, I'd like to ask you if you could repeat on that. You mentioned something about a possible stock market crash. You expect to see something of that in the next 6 to 8 weeks?
Yeah, I think we're really approaching, because the Federal Reserve did not announce official quantitative easing last week in its June meeting. I think it's going to come. I think they're going to print a lot of money and probably going to start in August. The only thing that makes me doubt my own statement is that it is an election year. However, if you look at Greece and what's going on in Europe, and then you combine that with the Federal Reserve not announcing more quantitative easing, which is needed for the banks, I do see the market having a huge correction here. One of the big signals for us is that the volume is really low. And when the volume is really low in the stock market, typically means, there's no confidence, there's no conviction. So what I think people will find out over the next 1.5 to 2 years is that this entire rally we've seen in the stock market since 2009, in history will show that this was just a large bear market rally. So I do see the Dow Jones going back down to the 6,000 point level. Right now it's currently at 12,500. Could go even lower. Of course, the wild card is how much stimulus the government will come out with, but right now that's not politically popular. So I would assume that the stock market would have a significant pullback here, and I think it's coming. I think it's imminent.
Okay. Well, thanks for that insight. Jan, we will have this recorded and available for review. I'm going to take just a minute here to go ahead and give everybody my contact information. In case you need anything like a link to this webinar, any questions about the network, I basically do the accounting, the bookkeeping, and a lot of that behind the network here. So again, my name is Patrick Prunty. The last name is Prunty. My email address is pprunty@mrren.com, and my direct phone number at the office is 949-885-8173. So Jan, to answer your question, if you want to send me an email, I'd be glad to send you a link to where we'll have this webinar stored, so you can forward it to anybody else that you'd like to share it with. Daniel, if you've got a couple more minutes, I have a couple more questions here.
I do, yeah, go ahead.
Okay, so I think this is also in regard to 401k money. It's coming from the same individual that asked about leveraging or buying outright cash. Would it be better to invest in trust deeds at 10 to 12% rather than real estate?
I wouldn't. If it's fixed, I wouldn't. Only because you don't want to have a fixed return in the U.S. dollar right now. Now the U.S. dollar, as Greece kind of blows up over there, the U.S. dollar could have a significant rally for 3 to 6 months. In fact, when I see the stock market crash, I see the U.S. dollar rallying. The U.S. dollar will rally for a few reasons, because number one, when you sell a stock, by default, you're converting it to U.S. dollars, so it creates an artificial demand for dollars. And also when the euro is weak, people are going to want dollars. So, I'm going to be wrong, I guess, on what I'm about to tell you for the next year probably. But the big picture, you do not want fixed income that is stuck fixed in U.S. currency. Now, when I talk about rental income, you can raise the rents. If there's a currency devaluation, you can raise the rents. So you can raise the next time you have your annual leases up. So you can revise that and fix that. But if you just have a 30-year note, I would not want to be a note holder right now.
All right, great. Thank you for that. I do have another question. It says, is it safe to invest in those funds that invest in medical facilities such as hospitals now? How is REITs compared to actual real property?
I think you're better off in real property. You have to remember a REIT and the mutual funds in medical area is still in the stock market. And it doesn't matter if you're the best stock in the world. If the stock market goes down, the stocks broadly will go down. So good example, if somebody just went to Yahoo and looked up the Dow Jones and then looked up a good company like ExxonMobil or something and just overlap them, it doesn't matter that ExxonMobil is making great profits and it's a good company. If the Dow Jones and stocks are selling off, everything will sell off, and that will include REITs, because ultimately stocks are not measured by the value of what the company is worth. It is valued on the supply and demand of stocks and the supply and demand of those stocks. So if there just simply isn't enough buyers, the sellers will have to go lower and lower prices. So, just to sum up the answer, I don't think you want to just be in U.S. mutual funds or even REITs. I would much rather be in a home where you control. Plus, a REIT gives you no tax benefits that I'm aware of, unless you're talking like an IRA or something. A house, you have a business now. You might need to write off your cell phone because you're going to call the tenants. You have to talk to your tax person, but there's a lot of benefits to having a house, and I don't see any having a REIT.
Excellent. Daniel, I have a question real quick. You said that you had purchased a couple properties this year so far. Can you share with us, I think you mentioned Memphis, Tennessee. Is that the only area you've been investing in now, or are there other areas you're currently looking at?
Yeah, I purchased in Indianapolis and in Memphis, and that's it in the network. I did purchase a second home, but it was in Nevada. So, but otherwise, Memphis through the network, and I actually owned through the network for a few years. So I'm very happy. I don't have an experience with these other people. I know you guys have a lot of people. I've heard the people in San Antonio are great and Atlanta is great, but I can tell you from my personal experience in Memphis, it's a no-brainer, slam dunker. They cash flow. They're selling these things for 50% less than it costs to build them. I like the Memphis economy. I like that it's very sustainable. It's off the Mississippi River. When you look for investments in real estate, I think because we are going into hard times, in the U.S., I think you should focus on buying in very sustainable and economies that you feel comfortable with.
Great. I did field another question here in regard to property owned in Fayetteville, North Carolina, that this investor is looking to unload now. The price has gone down this year. Should she wait for the election to sell, or sell now and try to buy someplace else and better the return now?
I would sell it now, because if there's a stock market crash, it could cause people to be fearful of buying anything. So I would sell right now.
Fantastic. Okay, Daniel, I'm sure there'll be some follow-up questions. Would you mind sharing your contact information if there's anybody listening that would like to follow up, after our webinar is complete here?
Yep, you can always go to Future Money Trends and go to the Contact Us page, but if you guys have a pen handy or you put on your notepad, it's my name. Let me go back here. Daniel Amaduri at yahoo.com. And just put in the subject, you listen to seminar, MRE or something, Marshall Rudnick Network. But Daniel Amaduri at yahoo.com, and that's the best email to reach me at.
Fantastic. Looks like I've got another question here. Do you happen to know offhand the zip codes in Memphis where you bought your properties recently?
You know, I do not know offhand. I'm one of those people who I just, you know, I'm very thankful that the Marshall Riddick people have introduced me to the right team. And I really just, you know, I buy them and I don't even think about them. You know, I know some people tell me they go visit them, and that's their prerogative, and you know, spend some time on them. But I really probably spend about 30 seconds on these properties a month. The only thing that I would make me spend more than 30 seconds is if the direct deposit didn't go through on the rents, because in Memphis, the property management company does a direct deposit on your rental income. So I do not know the zip code. Sorry, but I did purchase. I purchased houses in Memphis, duplexes in Memphis, and I purchased duplexes in Jackson, Tennessee, which is also part of the Memphis team. That area they cover. And I can tell you, you know, if you call them up and tell them you want Jackson, I can tell you that the Jackson stuff has done fantastic. And I'm talking about like the most consistent thing I've ever been a part of. I mean, when my Jackson duplex goes vacant, in 3 days I've got another tenant in there.
Yeah, no, I would have to agree with you. My experience with Ryan Tucker and John Moultrie and Chris Peak and those guys there in Memphis, they're just down-to-earth guys. They only bring fantastic property, and, you know, they've been with us. I think they actually might be our longest-standing account in the Marshall Riddick network. So you picked a dandy there. All right, with that said, I don't think we have any more questions. If anybody else does, you can go ahead and send now. Otherwise, if everyone's all good, we really, really appreciate you taking the opportunity and the time out of your day. I know we're all really busy. And Daniel, thank you to you. It was very enlightening, and I really appreciate your time. And feel free to give myself a call or an email, and Daniel an email should you have any further questions.
Thanks, guys. Thanks, everybody. You guys have a great evening.
Have a great evening. Bye-bye now.